Welcome to The Explainer. Today, we're tackling an absolute beast of a topic, but one that is absolutely crucial for your business, the essential Québec Payroll Checklist. If you've ever stared at a massive mountain of Revenue Quebec documents, felt a knot in your stomach, and kind of considered moving to a remote island, hey, you are not alone. Our goal today is to completely demystify this dense, high-stakes year-end compliance process and turn it into something totally manageable. So, I gotta ask, are you ready to face Revenue Quebec without breaking a sweat? I know these complex payroll requirements can cause a ton of anxiety. There are so many specific boxes, unique codes, rigid deadlines. It's a lot. But don't worry. We're going to transform this daunting task into a smooth, stress-free, and highly structured process together. All right, let's dive right in. Here is our master checklist for today's explainer. Spotless reconciliations, taming taxable benefits, mastering the RL1, conquering the annual summary, and finally, preparing for the new year. Following these steps in order is basically your roadmap to success. Step 1, start with spotless reconciliations. Basically, balancing the books before you even think about filing. This is the critical first phase where we make sure our internal remittance spreadsheet perfectly matches the Revenue Quebec statements. We do this to keep those disastrous discrepancy audits at bay. We're talking about reconciling your employee and employer Quebec pension plan or QPP contributions, QIPP premiums, Quebec income tax, health services fund contributions, and those CNSST health and safety premiums. The big takeaway here, doing regular source deduction reconciliations throughout the entire year makes this final year-end filing exponentially smoother. It is only after your payroll is perfectly reconciled and balanced that you can actually prepare your information slips. But here's the harsh reality. Any remittances not made by the due date for the last payroll of the tax year are straight up considered late by Revenue Quebec. Imagine you suddenly discover a forgotten manual bonus check from May. Well, if you catch this before your final payroll run, you can just include the statutory withholdings in that final on-time remittance. But if you miss it and process the adjustment later, you're going to get hit with compounding interest and penalty costs that literally continue to accrue until paid. It needlessly drives up your costs, and nobody wants that. Moving on to step 2 on our checklist, tame those taxable benefits, which is all about catching adjustments early. Revenue Quebec is super strict about this. Taxable benefits absolutely must be assessed for source deductions as they are received or enjoyed by the employee. That means this has to be handled on a pay period basis. A golden rule from the source material is, quote, employee year-to-date totals should be updated as soon as possible when a manual check is issued or direct deposits are reversed. There's real urgency here. If you wait until year-end to enter a mid-year manual adjustment, your payroll system might have already automatically calculated the maximum contribution amounts for the year. And that causes employees to over-contribute or under-contribute to QPP or QPIP, leaving you stuck doing super frustrating reimbursements. Now, even with incredibly diligent pay period tracking, you still have to compare estimated benefits versus actual benefits at year-end. For example, if an employee has a company-owned automobile, you've probably been applying an estimated taxable benefit per pay period all year based on estimated personal kilometers. But before that absolute last payroll is processed, you must calculate the actual annual taxable benefit using the actual personal kilometers driven and make your final adjustments. Okay, phase 3. Master the RL1 slip, which is navigating Quebec's information return. The RL1 is essentially the provincial counterpart to the federal T4, and you have to file it by the last day of February of each year for the preceding tax year. When you compare the two, there are a few huge differences to anchor in your mind. First, the RL1 uses alpha characters for boxes instead of numeric ones. It doesn't have bilingual headings. It notably excludes EI earnings, though it does report EI premiums. And crucially, every single RL1 slip requires a unique serial number, meaning you either have to order them directly from Revenue Quebec or use approved software to actually generate them. So the key here is making sure you map your data to the right alpha boxes. Box A is for your standard employment income. Box B is for QPP contributions. Box H handles your QIPP premiums, and Box J is specifically for employer-paid private health services plans. Oh, and here's a massive tip for you. Normally, if there's no amount to report, you just leave the box blank, right? Well, except for Box G, which is pensionable earnings under the QPP, and Box I, QIP insurable earnings. Those two must always have an amount entered, even if that amount is literally zero. Now, what happens when you have other income that just doesn't fit into those standard boxes? Well, you use box O. And this brings us to a very specific, kind of tricky scenario, code RZ. If an employee has more than one type of other income, let's say they have a retiring allowance and a research grant, you actually have to enter the alphabetic code RZ into the code O box. Then you have to spell out the corresponding specific codes and amounts for each type of income in the blank boxes in the center of the slip. And if you get this wrong or miss that end of February deadline, well, $2,500. That is the maximum penalty per slip for filing paper or XML data after the prescribed deadline. Because Revenue Quebec charges $25 a day per slip up to that $2,500 cap, non-compliance gets incredibly expensive, incredibly fast when you're talking about an entire workforce. Phase 4 on our checklist. Conquer the annual summary, meaning filing the RLZ-1-SV form. This summary form essentially reconciles all those individual RL1 amounts against what the employer actually remitted to the government. And you have to file it even if you had 0 remittances during the entire year. Now, a totally unique requirement found on this form is the Workforce Skills Development and Recognition Fund, or WSDRF. If your total annual Quebec payroll exceeds $2 million, you are strictly required to allot a minimum of 1% of that payroll to eligible training expenditures. If you fail to hit that 1% threshold, you actually have to calculate and pay the difference as a contribution penalty to the fund right there on the summary form. The summary is also where you calculate and remit your annual contributions related to labor standards. The standard rate here is 0.06% of subject remuneration, up to a per employee maximum. However, it's worth noting that certain public sector employers, like municipalities, schools, and daycares, enjoy a reduced rate of 0.03%. And that brings us to our final phase, phase 5. Prepare for the new year, setting yourself up for January success. Look, year-end isn't just about looking backward, right? It's about building forward momentum. So here is your rapid-fire startup checklist for the first payroll run of the new calendar year. First, clear and transfer year-to-date accruals like vacation balances. Second, advise employees to provide updated TP 115.3V forms if their personal claim codes have changed. Third, you gotta request new TP 115.R13.1V forms for your commission staff before January 31st. And critically, update your QPP, QPIP, and income tax rates in your system. A really great tip here is to proactively communicate these new rates to your employees before they see a smaller net pay on their first pay stub because their statutory deductions have restarted. We also have to keep an eye out for calendar anomalies. About every 7 years, the calendar falls in such a way that you're actually going to have 53 weekly pays in the year rather than 52. If this happens, you have to manually recalculate the QPP exception to make sure the annual maximum isn't exceeded. It's simple math. Step 1, take the $3,500 annual QPP basic exemption. Step 2, divide it by 53 weeks instead of 52. And Step 3, apply your newly adjusted $66.03 weekly exemption in your payroll system. Just whatever you do, don't forget to switch it back to normal at the start of the following year. So, we have officially walked through the entire process. Your compliance checklist is complete, but I'll leave you with this one final thought. Are your internal systems truly ready for that first January payroll? Because getting Revenue Quebec compliance right isn't just about frantically throwing numbers on a form in February. It's about setting up ironclad, structured workflows today that will save you time, avoid massive penalties, and reduce a whole lot of stress tomorrow. Keep this explainer handy to guide your reconciliations, double-check those alpha boxes, and go conquer your year-end.